What's up, everybody? Welcome to Gray Rabbit Finance. I'm your host, Tyler, and in today's lesson, I'm going to show you how to invest your money or 401k effectively for the ever changing seasons and market conditions. Let's hop in. What is money? In order to understand how to effectively invest, we must first understand what money is. The answer to this question is quite intuitive and simple. What do you think it is? To define money, here's a famous quote from J.P. Morgan. Gold is money and everything else is credit. Now, what did he mean by this? Well, let's take a look here at another diagram. This diagram is called Exeter's Pyramid and was first developed by John Exeter, a famous American economist and member of the Board of Governors of the United States Federal Reserve System. Originally, Exeter's Pyramid included third world countries' debt at the top of the pyramid in the riskiest position. But this modern version shows the current condition of derivatives holding the top position. In Exeter's scheme, gold represents the least risk at the base of the pyramid, holding the most reliable value. The asset classes on the higher levels are inherently riskier as they go up. The larger size of the asset classes at the higher levels is representative of the higher total worldwide notional value of those assets. Why is it important to understand this diagram? Well, guys, as we study history, we can see that human empires continuously repeat cycles of using sound money, gold and silver, and eventually this money becomes debased through inflation, until the money no longer functions as a store of value and the system collapses. At this point, sound money once again drives out the bad money. This causes paper derivative markets to collapse and wealth to flow from the top of the pyramid at the riskiest assets back down to the safety at the base of the pyramid, which is gold and silver. John Exeter famously said, "We are in a world of irredeemable paper money, a state of affairs unprecedented in history." Understanding where we are in this cycle helps us to decide how to be diversified amongst different asset classes. Right now, we are on the cusp of Phase 4, which is very important that we preserve our wealth as best as possible for our family and future generations. When Phase 4 kicks into full gear, wealth will flow from the top of Exeter's pyramid back to the safety of hard assets at the base of the pyramid. Being one step ahead of the masses will ensure our protection through these difficult and volatile market conditions. Now let's take a short trip in our time machine back to ancient Rome for more historical insights. Currency and the collapse of the Roman Empire. At its peak, the Roman Empire consisted of up to 130 million people over a span of 1.5 million square miles. Rome had conquered much of the known world. The empire built 50,000 miles of roads, as well as many aqueducts, amphitheaters, and other works that are still in use today. Our alphabet, calendar, languages, literature, and architecture borrow much from the Romans. Even concepts of Roman justice still remain, such as being innocent until proven guilty. How could such a powerful empire collapse? In 200 AD, flourishing trade was vital to Rome's expansion. It was trade that allowed the empire's influence to spread and a wide variety of goods to be imported into its borders. Beef, grains, glassware, iron, lead, leather, marble, olive oil, perfumes, purple dye, silk, silver, spices, timber, tin, and wine, just to name a few. Trade generated vast wealth for the citizens of Rome. However, the city of Rome itself had only 1 million people, and costs kept rising as the empire became larger. Administrative, logistical, and military costs kept adding up, and the empire had to find creative new ways to pay for things. Along with other factors, this led to hyperinflation, a weak economy, localization of trade, heavy taxation, and a financial crisis that crippled Rome. The major silver coin used during the first 220 years of the empire was the denarius. This coin was between the size of a modern US nickel and dime, and was worth approximately one full day's worth of work for a skilled laborer or craftsman. During the early stage of the empire, these coins were of high purity, holding about 4.5 grams of pure silver. However, with a finite supply of silver and gold entering the empire, Roman spending was limited by the amount of denarii that it could be minted. This made financing the pet projects of empires challenging. How was the newest war, thermae, palace, or circus to be paid for? Roman officials found a way to work around this. By decreasing the purity of their coinage, they were able to make more silver coins with the same face value. With more coins in circulation, the government could spend more, and so the content of silver dropped over the years. By the time of Marcus Aurelius, the denarius was only about 75% silver. Caracalla tried a different method of debasement. He introduced the double denarius, which was worth 2 times the denarius in face value. However, it had only the weight of 1.5 denarii. By the time of Gallienus, the coins had barely 5% silver. Each coin was a bronze core with a thin coating of silver. The shine quickly wore off to reveal the poor quality underneath. The effects of debasement took time to materialize. Adding more coins of poor quality into the circulation did not help increase prosperity. It just transferred wealth away from the people, and it meant that more coins were needed to pay for goods and services. At times, there was runaway inflation in the empire. For example, soldiers demanded far higher wages as the quality of coins diminished. Here's a quote from Caracalla. "Nobody should have any money but I, so that I may bestow it upon the soldiers." Caracalla raised soldiers' pay by 50% near 210 AD. By 265 AD, when there was only 0.5% silver left in a denarius, prices skyrocketed 1,000% across the Roman Empire. With soaring logistical and administrative costs and no precious metals left to plunder from enemies, the Romans levied more and more taxes against the people to sustain the empire. Hyperinflation, soaring taxes, and worthless money created a trifecta that dissolved much of Rome's trade. The economy was paralyzed. By the end of the 3rd century, any trade that was left was mostly local, using inefficient barter methods instead of any meaningful medium of exchange. During the crisis of the 3rd century, that's from 235 to 284 AD, there may have been more than 50 emperors. Most of these were murdered, assassinated, or killed in battle. The empire was in a free-for-all, and it split into 3 separate states. Constant civil wars meant that the empire's borders were vulnerable. Trade networks were disintegrated, and such activities became too dangerous. Barbarian invasions came from every direction. Plague was rampant, and so the Western Roman Empire would cease to exist by 476 AD. Okay guys, now that we've familiarized ourselves with history, let's take a look at the lifespan of currency. It comes as no surprise that the US dollar is facing challenges. Global reserve currencies have historically lasted in cycles of about 100 years, as seen on the currency chart. Fiat currencies have historically recorded an average lifespan of 27 years. The US has been serving as a global reserve currency for over 90 years, 40 of which as a fiat global reserve currency. If history repeats itself, then the US dollar is fast approaching its use-by date. It is little wonder that many are preparing not just for the inevitable loss of the dollar's reserve status, but also the demise of the currency itself. So why is it important to understand the lifespan of a global reserve currency and fiat currency? As a reserve currency loses status, that typically correlates with more conflict, uncertainty, and chaos within the world and financial markets. So knowing the average lifespan helps us keep one step ahead of the masses. Now guys, let's take a look at how most people traditionally have allocated their investment portfolios and 401ks. Here's a look at the Bogleheads 3-fund portfolio, and this is arguably the most popular lazy portfolio for passive investors. Bogleheads are followers of the advice and path of the famous Jack Bogle, founder of Vanguard and considered the father of index investing. The Bogleheads 3-fund portfolio is a simple portfolio made of 3 broad asset classes, usually a US total stock market index, a total international stock market index, and a total bond market index. The Bogleheads 3-fund portfolio draws on the idea of portfolio diversification's ability to reduce volatility and drawdowns, protect against black swan events, and maximize risk-adjusted return. Holding multiple uncorrelated assets invariably reduces risk and can result in higher returns, and almost always higher risk-adjusted returns, than holding one asset in isolation. Now let's take a look at the 60/40 portfolio. The 60/40 portfolio has long been the cornerstone for medium risk investing for all ages. Recent speculation suggests it might be dead. And its creator, Peter Bernstein, considered the 60/40 portfolio to be the center of gravity between risk and return. The 60/40 portfolio is simply a portfolio comprised of 60% stocks and 40% intermediate bonds. The idea is that the uncorrelation of bonds to stocks increases diversification, reduces volatility, and helps protect against drawdowns and black swan events. So, what is the problem with these styles of portfolios? Well, I would argue that most investors only have exposure to traditionally allocated stocks and bonds portfolios. These traditional portfolios have massive holes in their amount of diversification and are not prepared for the changes in economic regime, including an inflationary period and ultimately the decline of the US dollar as the global reserve currency. While backtesting shows the stellar performance of these portfolios over the past decades, we are now entering into a new era of investing where we will ultimately see the collapse of fiat currencies and the return to sound money. Now guys, how do we weather the upcoming storms in the market? Let's take a look. In 2023, there's a dangerous mix of economic conflict, global health, geopolitical tensions, military conflict risk, and inflationary risk. Most investors typically only have exposure to traditionally allocated stocks and bonds portfolios. These traditional portfolios have massive holes in their diversification and are not prepared for the coming inflationary periods. As you can see in this chart, during the period of stagflation experienced between 1971 to 1981, traditional stocks and bond portfolios severely underperformed in this era of low economic growth and high inflation. That's why I'm advocating for a shift to an all-weather style portfolio. This type of portfolio will have assets that work in periods of economic growth or economic decline that can occur in inflationary or deflationary periods. This shift is especially important for people closer to retirement age with smaller time horizon for investing. However, I think the market conditions we will experience over the next decade are going to be very volatile, and I would recommend you to consider having stronger diversification in your retirement/401k portfolios. Now let's take a look at a very popular all-weather portfolio. This is the original all-weather portfolio from Ray Dalio. The all-weather portfolio is a well-diversified, low-risk portfolio from the famous hedge fund manager Ray Dalio, designed to weather any economic environment. This portfolio aims to be prepared for any economic conditions or economic shocks. However, in an inflationary period, keeping too much of your wealth allocated to bonds is not optimal, as inflation will eat away at the real returns. And even Ray Dalio has voiced his concerns over the future of the bond markets and his allocation to bonds in the original all-weather portfolio. That's why I've taken Ray Dalio's concept of an all-weather approach and built an updated version of this portfolio more adaptable to the uncertainty of the coming economic seasons. The Gray Rabbit All-Weather portfolio is built to protect your wealth from all angles of attack. As Ray Dalio proposed, the markets have 4 major seasons. 1. Inflation. 2. Deflation. 3. Rising economic growth. And 4. Declining economic growth. The majority of investors today have only experienced a period of rising economic growth in a disinflationary environment. At least that condition has dominated their experience over the past 40 years, but the seasons are changing and our portfolios need to be adapted to the new conditions we find in today's markets. With a diversified portfolio, we can be prepared for stagflation, a deflationary market crash, a depression, prolonged levels of inflation, new pandemics, or the growing possibility of World War III. Now, I'm not trying to scare you or spread any fear, but I want you to ask yourself, have you done everything you can to preserve your hard-earned wealth for you and your loved ones? Now, this portfolio allocates 20% to global stocks, 20% to short-term bonds, 10% to consumer staples, 10% to healthcare, and 5% to commodities, 5% to energy, 10% to gold, 3% to silver, and 2% to crypto. Now, just to explain on that a little bit more, all of these allocations are going to help diversify you beyond the traditional stocks and bonds diversification, and it's going to help protect your wealth from inflation and also from deflationary crashes. So this is kind of just an all-around portfolio that's going to protect you from every angle of attack. And you can see that I've included cryptocurrency in here too at 2%, which I think, in these coming times, it's going to be important to have some of your wealth outside of the system. And so I recommend holding a portion of your wealth outside of the monetary system. And I recommend doing that in precious metals like gold and silver, and also in cryptocurrency. Now, if you want, in these allocations here, you can get exposure to gold and silver and crypto through paper derivative markets, but I do recommend that out of a percentage of this, you have some physical and you have some crypto stored off of an exchange on a cold wallet somewhere safe. So I think it's going to be very important to just protect yourself, protect your wealth, and to have some of your wealth outside of the system, just in case something happens. And now, as far as the rest of the allocations go, we have stocks and bonds, which is very similar to your typical portfolio. But what's different about this is that we're going to be holding commodities and energy, and we're also going to be holding consumer staples and healthcare. And so in a deflationary crash, consumer staples and healthcare stocks tend to do very well because, these are necessary to live. And so those stocks are not going to be as affected as other stocks could be. And as far as periods of inflation go, precious metals and commodities and energy always outperform in periods of low growth and high inflation. So by diversifying your portfolio to all these different allocations, you're just setting yourself up for having a extra protection for your wealth. And I'm going to show you some backtesting now. Here's a backtest comparison between the original Ray Dalio all-weather portfolio in blue and the Gray Rabbit all-weather portfolio in red. Now, since we have an allocation to Bitcoin at 2%, the data only takes us back to 2014. But as you can see, the Gray Rabbit all-weather portfolio outperformed the original all-weather portfolio by quite a lot, producing an improved CAGR or CAGR ratio, Sharpe ratio, and Sortino ratio, all while mitigating max drawdown risk. Now let's take a look and see how they compared to your standard 60-40 stocks and bonds portfolio. As you can see, the Gray Rabbit all-weather portfolio outperformed the traditional 60-40 portfolio as well. I imagine it will continue to do so over the coming decade as commodities, energy, and precious metal markets are severely undervalued to the broad equities markets. Now, backtesting has its place in analysis. However, past performance is not indicative of future performance. And myself as a professional trader, also I like to forecast future price targets. So let's hop into the charts and see why it's so important that we diversify out of traditional stocks and bonds portfolio into commodities, energy, precious metals, and the crypto markets. Okay guys, so now I want to get into the charts. And so like I said, backtesting has its time and place, but past results are not always indicative of future performance. And so that's why I want to just briefly walk through some technical analysis of all the allocations we've made in the Gray Rabbit all-weather portfolio. Now, if you guys are new to this channel, we do a monthly analysis covering all these markets. So I highly recommend you to check that out as well so you can stay up to date on the current price action. But right now I'm just going to give you an overview, and I'm going to bring home the point that we need to diversify beyond stocks and bonds, but we need to branch out and make sure that we have an all-weather portfolio heading into the next decade, because I do expect a lot of market turbulence and a lot of volatility. And I don't think many people are actually prepared with the way most portfolios are allocated these days. So let's look at the charts. This is a Vanguard Total World Stock Index, or the ticker is also VT if you want to look that up. But basically, I'm expecting, from the Ichimoku signals, this is looking like a bull trap to me. You can see a very long wick on this candle, so I'm expecting retracement to start happening between now and September, and I'm expecting further downside heading into the next year. So we can expect to see a 15% loss on the total stock market, and this is very similar to my S&P 500 monthly analysis. So make sure you check that out as well. But let's head into the next allocation. And just to reiterate, we allocated 20% of our total portfolio in the Gray Rabbit all-weather portfolio to this. And now we're going to head into this is the iShares US Healthcare ETF. And now, guys, I'm not going to spend too much time on this market because this is a ranging market. However, if you see on the stochastic, I expect the stochastic to continue down. And I'm expecting price to reach back down to Senko Span A on the Ichimoku cloud here. And I'm expecting that in the next year or so. And this is going to be from the current price level to this level is about 10% loss. So let's see how it plays out, but we need more price action in order to determine which way the market's heading for this. And just to reiterate on that, this is the iShares US Healthcare, and we allocated 10% to that, which these stocks tend to do pretty well relative to other stocks in prolonged periods of deflation. Now, let's take a look at the next one. This is the Spider Select Fund for Consumer Staples. The ticker is XLP, and this is very similar to the last market. This is a ranging market. We only have one out of the three Senyoku Kyoten signals, which, if you're not familiar with Ichimoku, I have an Introduction to Ichimoku series I highly recommend you check out. But if you're not a trader, no worries about that. This is a ranging market, which just means that it's bouncing up and down and it has no direction. But I'm expecting, based on the same facts as the last market we saw, I'm expecting price to head back down based on that stochastic. And we're going to see this is about the same loss. This is 9% instead of 10, heading into the next year. Now, let's get a look at the bond markets. So, as we mentioned before, the original all-weather portfolio had a very large allocation to bonds. And, that's something that Ray Dalio himself said that, he doesn't know who would want to be owning bonds right now because with the level of inflation that we're experiencing, bonds are going to be, you're going to be losing money to inflation still, even if you're invested in bonds. So, I think what he's trying to say is that perhaps there's other asset classes that can do a better job of protecting you from inflation and still maintaining an all-weather style portfolio. And that's what I was really trying to seek with the Gray Rabbit portfolio. And so these are the iShares 1 to 3 year Treasury bonds ETF. And as you can see, the Ichimoku is very bearish. The cloud's getting bigger. The price is below the Tenkan-sen and the Chikou span's below the candles. So I'm expecting an N wave down to this level here. And this is the 0.618 Fibonacci extension. And this is my target heading into 2025 for a loss of 2.5%. Oh, and just to mention too, from this, we allocated 20% of our portfolio to this, to the 1 to 3 year Treasury bonds. Now, guys, let's take a look at the iShares 20+ year Treasury bond ETF. Now, as you can see, the Ichimoku is also very bearish. The cloud's getting bigger. We have an N wave down like this, which reached its price target at the 1.272 Fibonacci extension level. So I'm expecting a retracement of price back to the $118 level heading into 2024, and I'm expecting a gain of 15% here. So this is actually looking pretty good for the short to medium term. And as you can see on the graph, we allocated 15% of our total portfolio to this. Now, guys, this is what I really want everyone to look at. This is the Invesco DB Commodity Index, and the ticker is DBC. But as you can see, we're forming a very nice cup and handle pattern here on the monthly chart. And I'm expecting price to reach the conservative target of this 1.272 Fibonacci extension level by 2031 for a gain of over 111%. So that's right up there. So guys, this is why I'm telling you, if you're not in commodities or starting to position yourself, you could miss out on the bull market. So just having a well-diversified portfolio is going to do a good job of protecting your wealth and saving your wealth from getting hit too hard by inflation. So this is why I'm advocating for more commodities. So yeah, that's the target right there. And now let's look at the Spider Select Fund Energy Select Sector. This is called XLE on its ticker. And as you can see, we also have a nice pattern forming here with a nice impulse wave up, which I think will eventually turn into an N wave in the bullish direction. And we have a cup and handle forming here. And I'm expecting price to reach the target of, this is the 1.272 Fibonacci target. And I'm expecting this to reach by 2029 for gains of over 95%. And so this is, XLE is just the broad energy sector. And you can look on their website if you'd like to see how these ETFs are broken down by their weighting and allocations. But these are just supposed to track the energy sector, basically. Now, you see that the commodities and energy are in our portfolio for both 5%. And now I want to move into another market that I think is looking poised for huge gains as well. Now, this is the Spider Gold Trust on the monthly chart. And you can also see the cup and handle pattern forming on this one. And these cup and handle patterns tend to break out very strong to the upside. And so I'm expecting price to reach the target of 1.272 Fibonacci extension level. And that's where we're going to get the carrot. And that's going to be around 2029 for gains over 40%. However, I think the gains will be much higher than that. But this is just a conservative target. Now, as you can see too, in our allocation, gold makes up 10%. And as you might have heard over the past years, many central banks have been increasing their stockpiles of gold just due to the turbulent environment that we're facing these days with, all the geopolitical tensions that we mentioned before, and also the fact that the dollar is hitting near its expiration date. So I can't emphasize this enough. Everyone should have exposure to precious metals, and I even recommend holding some physically if you can, but doing so safely. And that's something up to you guys to research on your own. Now, this market is even a little bit crazier here. This is the iShares Silver Trust on the monthly chart. And as you can see, we also have a massive cup and handle forming. And I expect price to reach the 1.272 Fibonacci level. And now, guys, I always expect price to hit this level because this is typically the level that institutional traders target. And so for me, this is a good target to hit, and it is pretty conservative target. So don't be surprised if we see even further upside. I mean, I wouldn't be surprised if we break out of this all-time high here. The price of silver has been artificially suppressed through the use of paper markets over the past I don't know, 40 to 50 years. But nonetheless, as we move into a greener world where we have more EVs and electric vehicles, solar panels, the demand for silver is going to be quite high for industrial purposes. So I don't think you can go wrong preserving some of your wealth in silver. Now, the silver market is a little bit more volatile than the gold market, so that's why we've only allocated about 3% of the Gray Rabbit all-weather portfolio to that. But I'm expecting this level to reach this price target here by 2028 for gains over 80%. And like I said, it could be much higher. And last but not least, now guys, this is Bitcoin US dollar on the monthly chart. And as you can see, we've only allocated 2% of our overall portfolio to this. And that's because this is a highly speculative asset class. There's a lot of uncertainties about the legislature, how it's going to be treated. Is Bitcoin a security? Is Bitcoin a commodity? Is Bitcoin a derivative? Is it money? We don't really know yet. And that's why I don't think you should not own it, and I don't think you should be scared of it, but I do think that you should tread carefully because, like I said, this is highly speculative, very volatile, but I do think that there's a place for it in everyone's portfolio. And so that's why I've allocated 2%, and it has performed quite nicely over the past years. So, I think it's a nice cherry on the top of the portfolio. But if you don't feel comfortable with this, feel free to just use this 2% as kind of like your own speculation, right? Have some fun with it. If you think you found the next moonshot, the next AMC, the next GameStop stock, feel free to play around with this part of your portfolio. But I do think that Bitcoin belongs in everyone's portfolio, or at least some exposure to crypto. And I think that you just have to evaluate your own risk and your own ideas about it, and just see how you feel about it. But like I said, we just allocated 2%, and this year I'm expecting Bitcoin to touch back down on this trend line. And like I mentioned before, guys, I do a monthly analysis. So if you want more details on this, please check back in every month. And we will be updating the price targets through technical analysis because, prices are always changing. And so technical analysis has to be flexible. And it's called Bayesian technical analysis, where you have a thesis, but this thesis is always subject to change when new evidence presents itself. And so until I see new evidence, I'm expecting Bitcoin to hit down on this trend line here. And then, we'll have to see from there where it goes. But check back in on the monthly analysis and make sure that you have at least 2% in your total portfolio. Guys, thanks for sticking with me until the end. I want to know what you think about all this. What are your favorite all-weather portfolio allocations? Do you think the 60/40 stock and bond portfolio is dead? Feel free to drop a comment below. And until next time, guys, peace, and thank you for liking and subscribing and sticking with me until the end. Peace.